Hey, what's up, everyone? What is up, Trade Pros? Happy Monday. Hope you're all doing well. Hope everything is good. We're starting this week off. It's a pretty eventful week that we do have ahead of us. It's going to be a more volatile week. More volume is going to be injected in the markets. First and foremost, if you're trading the S&P 500 futures, you'd probably want to switch to the U contracts, which are the September expiry from the M's. The M's were what were they? The M's were the June, which are expiring this week. So we got a few topics to talk about today, mainly what the news this week is going to look like, and then some of the other news that did come out from the overnight and from the weekend. So first and foremost, we have CPI data. We have CPI data, the inflation data, which is coming out on Tuesday. Last time we did see inflation slow down, and markets did like that, leading a lot of this rally. But we do have CPI that does come out on Tuesday pre-market. We're going to be trading that with our team. Then after that, we have PPI on Wednesday pre-market, which is going to be lesser of an event, but we have the FOMC, which is going to be a huge, huge event with the expectations that we stay constant in terms of the rates, no rate hikes, no cuts, just staying put between 5.25 percentage points. So that's to be expected along with the press conference, projections, all that good stuff. And then we have also on Wednesday, we have our weekly VIX expirations, the expirations of volatility. And to wrap up the week, we do have our Quadwitch, in which options and futures expire both on equities and on stocks. So looking at that, we have a very, very eventful week. We have a lot of volume that's expected to come in, especially with the contract shift as well. So I'm expecting to see a little more movement starting on Tuesday. Today could be a little more flat in the markets with some potential moves maybe into the end of the day, but the closer we get into that CPI report, which is going to be at 8:30 tomorrow morning, Eastern time, we are probably going to see a die down in movement in the overall market. So another thing to consider is VIX expiration, right? The expiry on the VIX happens on a monthly basis, and this month it's going to be on the 21st, so next week. Other than that, weekly VIX expirations with a VIX expiration, we do tend to see an immediate top in the markets, which could lead to a little more downside, right? I'm looking for a pullback, not necessarily something where we call cataclysmic lows. A lot of that does depend on how the Fed does talk and the projections of the Fed coming out on Wednesday, which again is going to be another event that we're going to be trading with our team. So last week, what we did was we wrapped up our futures trading workshop, right? It's going to be made available for you guys at later dates. But if you guys did enjoy that, now you're in our trading room. I hope everyone has a blast this week because I think there's going to be some decent moves that are going to happen, and we'll be guiding you throughout that. But news, right? Continuous credit card debt continues to jump up. In America, turning to plastic to counter their dwindling purchasing power. So, according to the Federal Reserve Bank of New York, consumers now own a record $988 billion on their cards, up 17% from a year earlier, or about $5,700 per person. While the steadily rising figure took a break during the pandemic years, the number is causing renewed nervousness as it flirts with the fast approaching $1 trillion milestone. So, high inflation is pushing more consumers to put non-discretionary spending on cards, while others may have been having a harder time pairing their prior lifestyles or bringing them back despite the price pressure. So interest rates are compounding the issue with an average annual percentage rate of now over 20%, making it really, really costly for debt consumers. So, or really costly debt for consumers, right? It's pretty expensive, especially if you rack up a $6,000 bill and keep it at that. It's also the highest than at any other point since the Fed started tracking card APRs in 1994. So contributing to the overall U.S. household debt that topped $17 trillion in Q1. So the first few years of the 2020s have seen a number of acute economic, financial, and geopolitical disruptions on a worldwide scale, and it took. I will take ultimate. It will take the ultimate consequences of these shocks to be fully felt. This is PIMCO writes in a new article called "The Aftershock Economy." So we look at a lot of individual stocks. You can look at Visa, you can look at MasterCard, you can look at American Express, Discover, right? If we take a look at how these things are shaping up, I'll type in V here quickly on TradingView, if I can load it. right? They've had a pretty strong rebound from those October lows. Mastercard as well. They're kind of topping out. They've topped out recently for sure. American Express had a decent little rally over the last few weeks. So these continued usages of these credit cards, they can realistically see a potential uptick in these names. So I'll be watching these in the coming weeks for sure. And then what's next for this? Well, economists have been predicting a recession for over a year. It has yet to appear, apparently, in part due to consumer spending. So some are more concerned about squeezed budgets as the Fed has not yet abandoned its hiking cycle, but is set to take more of a skip this week, right? And the expectations are for a July hike, and are closely watching carrying balance, delinquency rates, and wage comparisons to determine the direction of the economy. So others see things settling down, with companies foregoing further price increases or even cutting prices as consumer sales cool off. So that would help tame inflation and rising bills, as well as the support seen from the continued resilience in the labor market. So we also have the banking collapse, quote unquote, to talk about with Credit Suisse and UBS. UBS has completed its $3.25 trillion bill to buy out troubled rival CS, so Credit Suisse. About 2 months after the deal was brokered by the Swiss government to avoid the smaller banks' bankruptcy, UBS is also reportedly imposing stricter curbs on Credit Suisse bankers to address risks, so including banning new clients from high risk countries and the launch of new products without UBS's approval. So UBS might face more challenges ahead realistically, even though the deal does look like a bargain. UBS still can't fully estimate the cost of impaired assets, capital outflow, and other resulting losses. So we'll see how that does continue. I don't think we should have forgotten necessarily about the ongoing banking crisis, even though a lot of people have swept it under the rug. I think that there is low risk opportunity in KRE, which is the regional banking sector, to see a little pop to the upside. I know Michael Burry's been loading up on that one. In terms of how this market's shaping up right now, we still have headlines coming out of AI, which is the next, what seems to be the next massive rally in the market, and that could spread into 2024 along with the space sector. I think a lot of companies that are involved in AI and that are leading in AI are going to see larger jumps, larger potential jumps in revenue as well over the coming 12 months. So this is one of the main things that is keeping the overall market afloat pretty well, as we've rallied in names like Google and Microsoft, along with Nvidia, which are Nvidia hitting that $1 trillion market cap, sustaining a lot of this price action to the upside. So in today's trading session, starting off with Monday, I'm going to be waiting to see if we do have a little more sideways action, lower volume to start off the week. As I told you guys, we have a very heavy week in terms of news coming out starting tomorrow pre-market. So my expectations are to see more of a range shape up. We're in an immediate distribution over the past two trading sessions, so not a lot of data, but in between 43, we have to roll over to the U's, by the way, in between 43.66 to 68, all the way down to 43.47 to about 50. We have this larger distribution here that's shaping up, and I think we could see maybe some sellers try to open up here as the morning starts, and maybe some buyers sustain the downside of that distribution. We start jumping under 43.46 on the S&P 500 futures. I do expect a larger slip to the downside, which can start the next leg up. But I'll be watching very carefully, because the bulls liked Friday's action. They liked Friday's movement. They didn't necessarily like Friday's close, but we're still outside of that larger distribution that was formed a while back and then revisited last week for quite some time. So I'm going to be watching very carefully to see if any bears do try these high 60s, these 43 high 60s on the S&P 500 futures, and we'll go from there, right? I don't necessarily see too much directionality shaping up in the market today. If it happens, right, be on the right side, meaning that if we escape that balance that I was mentioning, be on the right side. But I do see a potential sustained balance into Tuesday's larger volatility event. So with that being said, we're going to be trading these with our team starting tomorrow pre-market and opening up our trading room right in a few minutes. And I hope to see you all there. Take care, chat soon, and we'll do this again tomorrow. Happy trading.